I'm going to go through the solutions to the first 4 questions in Part A of the 2017 paper in Property Finance and Investment. I'm doing these to give you a bit of an example of how to use a financial calculator. The calculator I'm using is actually not a financial calculator because mine seems to have disappeared. However, it will illustrate the way that even a regular scientific calculator can be used for most of the questions. In this case, I'm going to do questions 1 to 4. Let's look at question 1 now. If rents have been rising consistently at 3% per year, what can Jerome expect his annual rent to be in 2 years' time? This is a simple escalation question, and so we're going to be using the escalation factor, which is 1 plus I to the n. Here the escalation is going to be 3%. 1 plus 3% is 1.03. On the Hewlett-Packard calculator, I'm going to square that because I want it in 2 years' time. Put in 2. That becomes 1.06. I multiply 1.06 by the present rent, which is 11139. That gives me 11817. You'll notice that the solution that was actually given the full marks was anywhere $10 plus or minus 11820, and that was to account for rounding errors because I'm looking for the method more than ultra digit precision. And so if you came in with 11,817.3651, you would have got full marks, but you also would have got full marks if you'd submitted 11,820 or 11,815. Let's move on to question 2. Jerome expected to sell the property in 4 years' time. He expects the sale price to be 435,453 and selling expenses to be 10,886. Then what capital gain will he expect to pay? Well, first of all, we have to work out what the capital gain is. Capital gain is the sale price, that's 435,453, less the purchase price, 350,000. So there's an apparent capital gain of 85,453. We can subtract from that the purchase and sale fees. Purchase fees were 7,000, so we're going to subtract that, and then we're going to take off 10,886 with sale fees, so the taxable capital gain was 67,567. Now the nice thing about the capital gains legislation that for no particular logical reason we only have to pay half of the income tax on that, so we can divide that number by 2 and then we multiply it by the tax rate, which in this case we're told is 35%. And so the capital gains tax is $11,824. Don't need to worry about the cents, and in fact plus or minus $10 is give you full marks in the exam. If Jerome borrowed $297,500 in question 3 we're using an interest-only loan at 5.2%, what would his interest cost be? Well, it turns out the interest cost is the same year in, year out. If you're using an interest-only loan, it doesn't change. All we have to do is multiply 297,500 by 0.052, which is 5.2%, and that gives us $15,470, which will give you the right answer for question 3. Lastly, if his total after-tax cash flow for the year was a cash flow of 5,783, I'll put that in, and he adopted a discount rate of 9%, then what would the amount be equivalent to at the time he purchased the property 3 years ago? Here we're going to be discounting this value back by 3 years at 9%. Again, we use the escalation factor. In this case, I'm going to divide it. The factor now is 1 plus I, so it's 1.09, 1 plus 9%. We're going to cube that because we're talking about 3-year period. And we're actually going to divide the present cash flow by that number to get the historical cash flow, which is $4,465 and 53.71 cents, but anywhere around 4,465 will get you full marks. Now the last question I'm not going to answer because I do not have a financial calculator here. You can do it by memorizing the present value of an ordinary annuity function. I don't think many people will want to do that, but if you can, you're welcome to. If I had my financial calculator, I'd whip it out now. It's quite simple, but I can't. So that's about as much as we have for you.